Welcome to the November 2025 monthly motor checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at Motor Capital Management and Research. The title this month is Navigating Complexity with Master Oogway. This will all make sense, I promise, or at least I hope. Uh, First, a few quick disclosures as usual. Okay, so many of the most powerful ideas of complexity science permeate the world of investing. This includes topics like we hear these things quite often in the investment world, but they stem from the science of complexity, and it's the unpredictability, tipping points, chaos, unintended consequences, and so many more. The key thing that I've learned about studying complexity as it relates to markets is that once we understand the most productive behaviors for navigating complex systems, we're actually in a better position to thrive in that system despite not knowing the future. Because once again, one of the attributes of a complex system is that it's unpredictable. So it turns out when you actually study what you need to do to survive in complexity, and you can compare that to what we do as trend followers and momentum investors, it turns out that most of these desirable behaviors for navigating complexity largely describe what we do as trend followers and momentum investors. So, in other words, responding to change, not predicting it, embracing what is leading, not anticipating what will lead. So, in the timeless words of Master Oogway, one of the great martial artists and philosophers of all time, yesterday is history, tomorrow is a mystery, but today is a gift. That is why it is called the present. So while many are busy forecasting the future and fretting about what it might hold, understanding what is happening in the present is our edge for navigating the uncertainty of complex markets. And we're going to walk through much of what we discuss here throughout this video, and hopefully bring this all together. This is a chart that I've shown repeatedly through the various notes that I write on the website. Yeah, and and I do actually show this chart, and I highlight all the problems, all these divergences that existed prior to the 2000 early 2025 decline, and the fact that they exist today, and it might portend a similar outcome. And we'll talk more about this in this video, and we'll continue to talk about it in our research. But I think the key point is that we really don't need to understand why this is happening right now, or if it portends a good outcome or a bad outcome. We have to keep an open mind. It could be good, it could be bad, but most importantly is right now we don't need to know. We don't need to know what the future holds in order to know what to do today. We can rely on other tools that keep us grounded in the present to tell us what to do today in the context of what we see here. So in a true bull market, lagging stocks, the stocks that are underperforming, they go up. Generally speaking, they just go up a lot slower, and that's a traditional, very robust bull market. Sort of the rising tide lifts all boats. But in this particular bull market, which has been ongoing theoretically since the 2022 lows, um, the reality is that the stocks that have been underperforming the market have been going sideways for nearly 4 years now, just over 4 years. That is not that is not normal. It's not the first time this has ever happened. When you look through history, however, when it has happened, it's tended to be a precursor to a really bad outcome. That's just what the history tells us. It doesn't mean it's going to happen this time. We have to keep an open mind, and we can navigate that uncertainty by just responding to what is at the margin. And by the time this either resolves to the upside or the downside, we should hopefully be largely positioned for either outcome, once again, without forecasting anything. But this chart here is the Dow Jones Short Momentum Index, and it's basically long. So the index is long stocks, but the stocks that it's long are the stocks that are underperforming the broader market. So usually they're stocks that are going up. They're just going up less. And this was that recovery off of the COVID bottom. And so what we see here is the S&P since this bottom has gone out to new highs, and this is what the average stock has done that's been underperforming. So again, it's quite different. Not the first time in history, but it's very abnormal. We'll say it that way. So for us, rather than fret about what will be and what this all means, what I prefer to do is just anchor to what is. And there's plenty of information and there's plenty of guideposts to anchor ourselves to what is and then just make changes at the margin. So we'll just continue to do what is until that no longer is. So of course, the way we do that is the risk gauge. And when we look at the risk gauge, which pulls together the five inviolable concepts that we believe to be inviolable, sort of like first principle concepts of trend following. When we pull all those together and let them bubble up to the surface in a cohesive sort of summary statistic, we have this mixed reading that continues. This is the longest run of sort of mixed readings in the risk gauge that I've ever seen in all the studying that I've done with it. Um, we've been trying to register risk on readings over here in the medium term and long term. You've noticed a couple times it's tried to get into that risk on, and it just continues to fail, and it's failed once again. And so that just means that it's not bullish, it's not bearish. It's what? Well, it's mixed. That's why I call it mixed. So we can't really have a bias necessarily here. And I would say that if you're just a long-term investor looking to be long the S&P 500, mixed is good enough. I mean, you just obviously we can see an environment where the S&P has continued higher, despite the fact that the broader underpinnings of the structure of the market are mixed. So it's not, to my point, it's not necessarily bearish. But if you're in the weeds, managing money in the weeds beneath the surface of the S&P 500, you find two things. You find actually a lot of stocks that are outperforming the Mag 7, but you also find a lot of stocks that are not just underperforming the market, but are underperforming by going down. And that's the environment that we are in and have been in, and I think that the risk gauge will help navigate us and notify us when that's changing at the margin. So there is something that is really truly surprising to me about what is uh, today, and I've mentioned this a couple times in the research, but I thought I'd highlight it once again. Um, these are the 28 the 28 motor groups, right? So one step down from sector. And what we're looking at here is measuring how far or what percentage of the market, what in this case the motor universe, what percentage of the universe has gone on to hit a high that's higher than the high it hit in 2021. So we know the S&P has clearly done that, right? So we had the big run up into late 21, and we had the consolidation, and then went down into the 2021 lows, and the S&P has since done that, thereby exceeding this high. The question is, what percentage of the market has actually done that same thing? And it turns out it's only 62%. So the good news is it's the majority, but it's a small majority. It's not a significant majority. And then more perhaps troubling, don't want to label it too much, but perhaps certainly interesting, is that even though 62% have exceeded that high, a lot of them have actually failed and have come back down again. So as of today, literally as of this afternoon, I ran these statistics, only 38% of the motor universe is above where it was at its high in 2021. So a lot of stocks went past that high, but many of them have since come back down and are now below that high. So that's the reality of what is happening beneath the surface. It's what the value line geometric average is trying to tell us, and it's what a lot of the statistics that I provide in the research, and I'll show you a couple more in a moment, that are basically saying there is a lot of damage beneath the surface. It's a fragile environment. It's certainly not bearish yet, but unless things change, I suspect they eventually will be, but we don't need to forecast that. We'll identify it as it's unfolding. But this over here on the right side of the table is looking at what percentage of the motor universe actually went to a lower low below the 2022 bear market low. So after the market itself bottomed, a full 58% of the market after that since 2022 have actually gone to lower lows. Now, the good news is that many of them came back. And as of right now, quote unquote, only 25% of the motor universe is below where it was in 2023. But so that means that 75% is above that low. But nonetheless, a full quarter of the market is not only not above its 2021 peak, but it's actually still below its 2023 bottom. So this, I'm telling you once again, is just not normal. It's clearly not bearish yet, but it's absolutely something we want to pay attention to because this is not sustainable. It's a very fragile environment, as I've been saying. So most stocks are in a monthly time frame uptrend, which is again at the margin. This is not bearish. It's some degree of bullish, and this is the motor trend model, and we can see over here that 59% of the Sorry about that. Had to close a window. 59% of the motor universe is in an uptrend. Now that's a small majority, but it is a majority, and it's the reason that we're not bearish. We can and obviously will get tactically bearish, but within the context of the big picture, this is not bearish. It's not robustly bullish, but it's not bearish. And a couple things that kind of really stand out is that well, let's just flip this upside down, and we can say that 41% of the market, keeping in mind that this is the monthly chart, right? So this is a long-term chart. Still, 41% of the market either looks like this on the monthly chart, or in a best case scenario, looks like this. So with the S&P doing this, it seems quite strange that a very large part of the market's doing that on the monthly chart. So that's obviously not healthy. We'll say it that way. It underpins that notion of a fragile environment. But here's where it's not bearish. When you look at what is leading, the biggest trend bucket of the six trend buckets, still on the monthly chart, the biggest trend bucket is a clear uptrend. So charts that look like this on the monthly chart without consolidation, all of the groups that are leading, that's their biggest bucket. So that's clearly suggests that there's enough structure underpinning the leadership that we still have reason to not expect a significant decline from here. But it also suggests that, as I've mentioned in the past, to go from uptrend to downtrend, you don't typically just go from here to here in a month. What typically happens is you go from here to here, which is an oversold uptrend, oversold base in an uptrend, back to an overbought base in an uptrend. And you might go back and forth in here a couple times. And keep in mind, this is the monthly chart, so this could be 5, 6 months before you eventually go here. So that means what I just described is that you don't typically do this. What you typically do is this. And then that, right? That's this right here. That's that distribution process, and that would unfold by going here first, and then back here, and then back and forth, and then you go here. It will be able to monitor that one. I monitor it throughout the day, but certainly 1 month at a time, we'll be able to identify if this is deteriorating beneath the surface. So that's all the good stuff. The bad stuff is when you look down here, a couple things. Look at this group right here. This is software and services. What on earth is software and services doing down here? It's ranked number 27 out of 28 in the very short term momentum, but also in the long-term momentum. And there's only 43% in an uptrend. In the biggest trend, sorry about that, 38%. In the biggest trend bucket is 40% looks like this on the monthly chart without any consolidation. This is software. And then capital markets. This is a very risk-on group, retail, um, credit and credit services, capital goods, uh, and semis have taken a bit on the chin of late. So in consumer durables is no ranked number 20, and in here you have big ticket items like boats and RVs and things like that. But you also have houses and these big ticket consumer durables, and these are very economically sensitive parts of the economy, of course, and they're all down here, and many of them have this as their largest trend bucket. So again, this just goes to once again with numbers bring to life the stuff that's going on beneath the surface of the value line geometric average. It's just not what the S&P is saying is just not the full truth. Okay, so once again, sort of this offsetting mixed environment. Leaders keep leading, which you can see here. This chart here is once again table is showing us the 28 groups as they were on the previous chart. And what we're looking at here are the relative performance highs and lows over various time periods. So when we're looking at the 1 month relative high and the 1 month relative low over the past 5 days. So biotech, which is the number one very short-term momentum and the number four long-term momentum score, we can see that in the past 5 days, 46% have hit a 1 month relative high and only 24% have hit a 1 month relative low. So that spread is 21% positive. And then as you do that analysis all the way out, they're very healthy numbers. These are 3 month relative highs and lows, 6 months relative highs and lows, and then 1 year relative highs and lows over various look back periods. And so when you just look at the top table here, you see a lot of green, maybe some yellow, but it's all basically, for the most part, positive numbers, indicating that more relative highs are being hit than relative lows. And so this is one of the divergences we'll be watching for. Are we getting a lot of price highs but not relative highs? And what this is showing us is that at the margin, it's pretty supportive of current leadership. Which, again, it's not like it's, really, really great leadership. We have utilities, insurance, we have banks in there, telecom. So there's a lot of defensive groups in here. So that's a little bit concerning. We also have a lot of late cycle groups in here, like energy and industrial metals, and we finally just got transports in there. So these are some late cycle leadership, which has its kind of own warning embedded in it, but it's leadership right now, and it's trending, and it's hitting relative performance highs. So we're not too concerned about it. And I can't help but point out that, and I've been talking a lot about this, but there's a lot of healthcare. All four healthcare groups are now in the leadership. And I'll talk about that in a moment, because the question is this just another movement or transition towards safety within the market that we should be concerned about? And I'm not dismissing it, but I'm going to show you some data that suggests that for now we shouldn't worry too much about it. But then when you look down here at the laggards, which again is a lot of cyclicality down here, you see a lot of red. You see a lot of negative numbers here. So you see what you're seeing is, in some cases, good price trends, but in many cases, bad price trends, and in almost all cases, relative performance lows. So again, what's working is working, what's not working is not working, and so that just is what it is. That's the present conditions that we're navigating through. That's the complexity we're faced with. And if we're just making changes at the margin to reflect what's happening in the environment that we're in, we should be doing both. We should be, assuming you can be short, you should be shorting the things at the bottom of this table, and you should be long the things at the top of the table. If you're just long only, then you should just be long the top part of this table. And if you're just a passive investor who just owns ETFs, or perhaps owns the SPYs or the Qs, this is an environment that's at least not bearish. So we can at least draw that conclusion. So at the recent lows, 40 of the 178 motor industries had no stocks in the industry above the 15-day average. So I wrote about this in the research, but that's an extremely oversold condition where you have almost a quarter of the industries had no stocks whatsoever above the 15-day average. That since then, with the snapback rally that we've had, has largely because of that magnitude and degree of oversold, that's recovered quite a bit. So now, as you can see over here, we have a lot of industries that have many stocks above their 15-day average. You can see that over here. And so you can see a couple that are still there, like clean energy still has no stocks above the 15-day average. So, but it's largely been cleared up. And what I think we can look at here is the groups that I've been highlighting as potential bubble groups, which is still the working hypothesis for me at least. You can see that when you sort this table by long-term momentum, they still are largely what's leading. Like about approximately half this table is new era industries, and so that to me continues to corroborate the idea that we are still in that sort of bubble environment, which again is not something to run away from, as I wrote last month or the month before. This is something you want to embrace. If you have the willingness to be tactical and ability to be tactical, and the willingness to be disciplined about managing your risk and moving with change at the margin, then these bubble environments, you should be embracing them. But what I wanted to highlight here is that with this table sorted by the long-term momentum, if these are leadership groups, which they are, one of the things we like to look for is these really blown up short-term scores. So the one that we've been focusing on recently is the crypto industry. It has gone from one of the best ranked short-term industries in the short term all the way down to 98. So it's near the bottom of the bucket. But yet, having done that, it's done very little, if anything, to its long-term trend score or momentum score. So this in our mind, sets the opportunity for a potential, at minimum, a great place to enter. Whether it makes money or not, we'll find out. But this is a good place to enter these types of names, and you can see it unfolding here in ride-sharing services, stocks like Uber, and then you can see a couple of them here as well: drones, robots in space, consumer products and electronics. So this to me is a great way to find potential buy ideas among the leadership. It's just really big pullbacks in otherwise healthy momentum scores. So the point is that the recent decline that we just kind of witnessed and went through, and I'll be drilling down on that in a second. But that recent decline, the good news is that nothing new was broken, and so it's as bad as it was before. It didn't get worse, and that's again kind of leaves us with that mixed environment. But despite the magnitude and swiftness of this rally, nothing has been fixed either. So that leaves us with once again that mixed environment. So nothing at the margin has really changed too much. So that leaves us with this notion of like if you look at the performance of the various popular averages, are we having a strong quarter? And if you just look at the ETFs like the S&P 500, it's up 2.2% approximately. The Qs are up about 251. The IWM, which is the Russell 2000 small caps, up 273. So by any measure, I would think that would be considered a good quarter to date so far, keeping in mind that we still have all of December left, right? So I think most people would be happy if they receive this type of performance every quarter, right? So clearly a good quarter. However, when you drill beneath the surface and you look at a more broader swath of companies, you have the motor universe, which is about almost 3,000 companies. It's still up, but it's up only 148 basis points. And then taking a turn for the worse, once again, is the value line geometric average is actually down 152 basis points this quarter. And if you're looking at this data and scratching your head and saying, how can that be possible? I'm turning this video off. This doesn't even make sense. Let me let me put some numbers behind that before you dismiss it. Um, this is the once again the Motor Universe groups, and what we are sorting by is the quarter to date change. So this we're sorting by this bucket. And what I'm describing is a very mixed environment. So what evidence can I point to beyond the value line geometric average being down this much when the popular S&P is up this much? What else can I point to? Well, when you look at the 28 groups, almost half of them are not only underperforming, they're down quarter to date. And again, it's not us, these are not unimportant groups. This is materials, uh, consumer durables, retail, capital goods, credit services, capital markets. Here's software and services again, down 7.37%, with only 29% of them up on the quarter. So this is the reality of what's happening beneath the surface. And again, I'm stressing it's not bearish because this means that there's plenty to do. And there's just other ways to demonstrate this. So if I show you this table here, this is the dashboard that we've been spending a lot of time on this month, and hopefully in the next few weeks, the next few days, I should say, you'll be able to see this dashboard live on the website, and you'll be able to go in and search through it like we do, looking for ideas. But what this is showing you the dashboard quarter to date, and it's showing you the five biggest gainers quarter to date. So here's number one, two, three, four, and five, and the ticker is here. And so when you look at this table, there's a lot of big movers. I mean, look at these numbers. These are the changes quarter to date. Some of the 100%, et cetera. So there's a lot of really big moves quarter to date here. And when you step back and look at the coloring of the table, there's an awful lot of green here. So this is just leaders leading, kind of getting back to what I said earlier. Um, so that's for this reason, there's plenty of things to find to get to be long, and we're when you adjust for beta and whatnot, we're about 105% long right now. So there's plenty to do on the long side. But this is that same table, but instead of showing you the five best performers, these are the five worst performers. And what should jump off this table almost immediately, if certainly not after I pointed out, is that this is almost entirely red, indicating that what's been not working is really not working. And when I say really not working, look at these numbers. So at the same time we have stocks going up 30, 40, 50, 100%, we have a whole swath of the market that's down 20, 30, 40, 50%. This is the worst column over here, and you can see a lot of damage being done, right? And you can even see damage being done in the leadership groups. So there's plenty to be short, and there's plenty to be long, and that was my message last month, and continues to be my message, not because that's what I think, it's because what I see, and I see that vis-a-vis data studies like this. So in complexity science, navigating complexity, what matters most is change at the margin. Just figure out what's going on, get some feedback from the feedback loops, right? That's another term that comes from this complexity environment. And it's through that process of engaging with feedback loops, whether the last thing you did was a good thing or a bad thing, and continue doing the good things and stop doing the bad things. That's change at the margin, and that's what matters most in complexity. And so, therefore, it's what matters most in trend following and momentum investing. So, I just want to finish up with a quick discussion on the what I think is one of the biggest changes at the margin and it's the improvement in the four healthcare groups into the leadership of the motor universe. And so the immediate concern would be that it looks like the market is shifting towards it's transitioning its capital towards safety because healthcare is and as I'll show you is perceived to be a very safe sector. It's like kind of where you go during bear markets. And when it first started to happen, my point then was that I'm less concerned about it because the first healthcare group to get into leadership, and this is a couple months ago, was biotech, which is a very risk-on group. I would be a lot more concerned about the three other healthcare groups being in the leadership and seeing biotech down at the bottom. But not only is that not what happened, it's the opposite is what's happened. So the biotech got into the leadership first. It's prolific today. There's so many buy ideas in biotechs, and then the other three groups um, joined the party after. And that progression led me to kind of dust off the what we call the relative performance type model and just kind of run the whole motor universe through it and see what was the cause for the healthcare sector's improvement. And I'll show you that in a moment. But before we do that, just to put that what I'm about to show you in context, this is the bottom line is the relative performance of the healthcare sector versus the market back to 1999. So we're looking at a quarter of a century, over a quarter of a century, just over of relative performance, and it essentially with a lot of significant back and forth movements, it essentially nonetheless peaked in 2002, 2003, and more recently hit a new relative performance low. That's how bad it's been over the past essentially 25 years. And when you break down the relative performance of the sector, what you find is that in the past 25 years, there's only been one environment where the sector led the market in a bull market. And so this herein lies the question, like, if it hasn't had a tendency to lead in bull markets, the fact that it's becoming leadership now, is that a concern? Because is that the market's way of telling us that it's hunkering down for a bear market? Because as you can see, the biggest, most powerful periods of relative outperformance came during stock market bear markets. And then the predominant amount of underperformance actually in these blue boxes came during bull markets where the sector just underperformed during a bull market. And in fact, as I said earlier, the last most recent bout of underperformance during a bull market has actually pushed the relative performance line below its lows of the past 25 years. So it's actually a multi-decade relative performance low. So this, of course, looks very problematic. If you're looking for reasons to be bearish, this would be one of them because the market is clearly, at least apparently, transitioning towards safety. So dusting off the relative performance type model to address this, this is what we found. Over here is the healthcare sector, and over here are the I think it's nine relative performance types. And they're just every stock gets a label. And so all nearly 3,000 stocks are somewhere in these relative performance buckets. And most admired are stocks that do well kind of like all the time, bull market, bear market. Strength one do really well during a bull market, but they get destroyed in a bear market, and then it's just varying degrees of less and less strength as you go down. And then most neglected can't get out of their own way. They can't do well in a bull market. They can't do well in a bear market. This is where you would go to look for short ideas. By the way, when you look at our short exposure, it turns out we are actually short a lot of most neglected stocks. Safety one is the safest of all of these relative performance types. It's where you go if you want to be hunkering down for a bear market. And then these are all safe, just varying degrees of safety as you go lower. So that's the relative performance type model. Now, the benefit of this is you can then run a universe through it and see, for instance, here's the most admired bucket. where are 100% of the bucket, where are these stocks? What sectors are the most admired in? And what you see is that the biggest bucket, and we know that because it's blue, is healthcare. Healthcare is the biggest bucket in the biggest sector or the biggest exposure in most admired. It's also the second, it's also the biggest bucket in strength two and strength one and strength two, sorry. But it's also the biggest bucket in safety two. So uh, just a bit of more information on the model. If you're looking to position for a bull market, the four buckets you want to favor: most admired, strength one, strength two, and safety two. Those are the four buckets that tend to do best in a bull market. And it turns out that those each of those buckets are all most overweight or most exposed to, I should say, the healthcare sector. So it appears, based on this model, that the capital that's been migrating into healthcare actually has more of a bull market leadership tendency to it. Now, that doesn't mean we're not going to correct. It also doesn't mean that we're not going to go into a bear market. But what it probably would mean that if we did go into a bear market is that what healthcare would outperform because it hit a lot of these. This most admired does have safety. This has safety, and this has safety as well. The only purely um, exposed, the only group that's exposed purely to strength and no safety is strength one. So all these other three do have safety. So it's fair to think that the healthcare sector would outperform in a bear market. But this taking these all together, the fact that healthcare is the biggest exposure in all of these buckets suggests that even if we do have a bear market, when that bear market is over, healthcare would be the leadership, much like industrials were the outperformers during the 2022 bear market and have pretty much since been the leadership since then. So this to me is one more reason to not quite yet conclude that the market's simply transitioning to a very defensive, safety-oriented sector, hunkering down for something really bad. It could be. And as I said, even if it does, this this mapping suggests to me that even if it does, healthcare stands a pretty good chance of resolving this trend upward, perhaps first by outperforming in a bear market and then finishing it off by outperforming in a bull market. And I say that only because if the group was taking on leadership and this bucket was 50%, which is safety one, I'd be really concerned about that. But it's not. It's underweight. The safety one bucket is underweight healthcare relative to the healthcare's weight in the market. So that's just one perspective. Keeping an open mind, but this at least keeps me thinking that we shouldn't overreact yet to the healthcare sector's leadership, and that we should actually be open to it potentially leading in the next bull market, like it did. Oop, we got to get rid of that. Like the sector led in this bull market here. Because again, it's done it, and it used to do it back here in the 80s and 90s. It was had its bouts of bull market leadership. So again, keeping an open mind. And then lastly, I thought this was interesting. What's happening, and I want to put in context this idea that I think we can get new highs from the S&P, and why, unless things change materially, it's not going to mean anything. We still have the potential that we could get another tactical swing trade to the downside where you can actually make some money on the short side, even though it's in the context of an ongoing mixed environment, which is kind of what we just did at the beginning of the year. So much so, I'll show you what I mean by that. So back then we had this head and shoulders top, and a lot of people were writing about it. I might have even written about it at the time myself, but I do also remember in that moment that the market was really oversold in here. Like we had uh, a number of leadership sectors were very oversold. And with that, what did the market do? Instead of following through on the downside and meeting its downside target for the head and shoulders, it actually confounded everybody and went out to new highs. And thereby leading us to believe, not us, because we actually started to get short shortly after this, but leading, I guess, people that just follow the market based on the S&P to believe that everything was fine. But what we knew, and we wrote about it at the time, was that as the S&P went out to new highs, most stocks did not. So I showed you this chart to begin with at the outset. And if this was the value line geometric with that same rally, the value line geometric average was way down here with a significant relative, breadth divergence with the S&P. So as good as the S&P looked, the average stock looked more like this. And then, of course, the whole thing came unglued. Now, what I find particularly interesting is that we seem to be seeing the same exact, not exact, but things rhyme in markets, and it seems like we're rhyming with that once again. And this, one of the notes I wrote recently was that, I think that we could see this once again where we have a head and shoulders uh, top that doesn't follow through because we got really oversold. And remember, I just told you that 40 of nearly 25% of the motor groups had no stocks above their 15-day average right here at the lows. So that's reason to believe that we can get a pretty strong rally, and that's essentially what we've gotten since then. So I could see us going to a new high on the S&P, but at the same time, remember, I could also see it being highly divergent because remember, as I showed you on the first chart, the value line geometric average is down here. So we have this divergence setting up just like we did at the beginning of the year. And so what we know followed the the prior example, we should be open to that. Again, we'll be following this one stock at a time, one sector rotation at a time, one relative performance breakout in both directions at a time. But for now, tactically speaking, I think new highs from the S&P, probably participation with that from the value line geometric average. But when it's all said and done and we're back to overbought, you'll see once again a significant divergence between the two. And that's when we really got to be on guard for another downdraft in the market. Okay, so just to wrap up, 2026 is almost guaranteed to be a complex year. But in that context, I mean literally from a complexity standpoint, with uncertainty as to the future Fed cuts, concerns about liquidity, obviously the continually haunting sovereign debt crisis, midterm elections, tariffs, and a whole lot more. All of this, of course, is offset by a massive AI-driven spending cycle. So there's obviously we talk about this K-shaped economy where some people are doing really well and other people are not doing so well. That's reflected perfectly in the market. That's exactly what I just described to you. We have a K-shaped market, and these are the drivers that are driving that shape of a K, if you will. So the degree to which the market participation today is so disjointed. To me, what that is telling us is that the market is processing all of this, and it's processing things in the manner in which all of these things work together and how they relate to each other in ways that we can't appreciate right now. But what it's doing nonetheless, all along the way, is determining what the winners and the losers are today. And we just should be reflecting that in our portfolios. Now, whether this means ultimately that the loser is the whole market and eventually goes down in a full bear market, or we just continue with these pockets of winners and losers, or the whole thing just settles down, recalibrates, and the whole market goes higher. We don't know. We don't need to know that in order to know what to do today. But that change will manifest one data point at the time, as I said earlier, at the margin, and that's what we'll be tracking for going forward. So with us, of course, we are extremely engaged in the data as it is today. So what does that mean to us as a portfolio manager? Well, that means that we are long leaders, we are short laggards, but overall, we're positioned for higher highs into 2026. And when you beta adjust our exposure, we're about 105% long. Just to put into context how we, as at least one money manager who is processing all this information through this sort of complexity lens and the systematic bottom-up process, we are left with still a bullish positioning for at least for the first half of 2026, and we'll just take it one step at a time from there. Now, this obviously will absolutely change in time, but it won't change because we made some great forecast or we kind of woke up one day and said that we're really bullish or we're really bearish. And it's most definitely not going to be a change that we make because of somebody else's forecast. It will simply be the result of our pursuing our edge, which is listening to the market. And we believe that the way we're positioning today does reflect what the market is trying to tell us. Very mixed. We should be long the market, but if you can and have the capacity, you should also be short. And but net with a biased position with a position that is biased to the market, still for now resolving to the upside, and then we'll just take it one step at a time from there. As always, thank you so much for watching and tuning in this month. Please reach out to me if you have any questions. You can see my email here, and I look forward to connecting with you again next month. Thanks so much.